third quarter results and trading update season moves into top gear on both sides of the Atlantic in the coming week. Investors and analysts will therefore glean fresh insight into whether trade talks and tariffs, inflation and interest rate movements are having any discernible effect on profits and cash flows at companies, be it positively or negatively. Particular attention may go to the banks in light of the First Brands and Tricolour collapses in the USA, and worries over any possible deeper spillover into or from the worlds of private credit and private equity. Investors will also look to technology stocks, and in particular those that are seen to be players on artificial intelligence or AI, for reassurance on their earnings, and also that their huge spending on data centres, servers and chipsets is money well spent. The Magnificent Seven represents some 36% of the S&P 500 index's total stock market capitalisation as I sit here, so those names are likely to exert a hefty influence going forward, and two of them report results in the coming week. They are Tesla on Wednesday the 22nd of October and Amazon.com on Thursday the 23rd. Both shares are trading, by the way, just a fraction below the all-time highs that they reached sometime within the past year. The other 5 of the 7, by the way, will report as follows. Alphabet, Microsoft and Meta all are due on the 29th of October, Apple on the 30th, and Nvidia, which reports off quarter, on the 19th of November. Now, Tesla's already reported record car deliveries of just over 497,000 units for the quarter, although production of 447,000, that's still some 10% below the high reached in the final 3 months of 2023. That suggests the company may still be working through some inventory. Analysts will also look to the revenue trends in energy storage and the other segment to see how AI, robotaxis and robotics are starting to move the dial at the company, as these operations are probably the reason why the stock still has a $1.4 trillion valuation, when Tesla is expected to make less money after tax than Chinese car maker and rival BYD, which is a stock market valuation of barely $140 billion, or 90% less, despite the fact, again, it has higher earnings. Analysts will then go straight to the headline numbers, where the consensus analyst forecasts are looking for, from Tesla's third quarter, sales of $26.3 billion, up 4% year on year, net income of $1.6 billion, and earnings per share of, or EPS, of 52 cents, down by more than a quarter year on year. In the unlikely event we get any detailed guidance for the fourth period, the consensus estimates looking for sales of $25.3 billion and earnings per share of 45 cents, way below the 73 cents a share in the fourth quarter of 2024. Do also watch the cash flow statement and the balance sheet, even if Tesla's got some $30 billion in net cash stashed away there, especially as inventory days have been running ahead of historic norms. Amazon.com's third quarter results will come the day after those of Tesla. As usual, the company has provided a wide guidance range for the quarter, partly because it's got so many moving parts, partly because management seem less fussed about near-term performance trends, and partly because the company has never been afraid to invest for the long term if it feels the need and take the short-term profit hit. Alongside the second quarter, boss Andy Jassy guided for the third quarter to look as follows. Sales between $174 and $179.5 billion, up 12% year on year at the midpoint. Operating profit between $15.5 and $20.5 billion, up 4% at the midpoint, and analysts think that means headline earnings per share figure of $1.58, up 8% from the year before. For the fourth quarter, current analyst consensus expectations are for sales of $208 billion and earnings per share of $1.89, up 10% and flat, respectively. Much attention will focus on capital investment, a massive $32.2 billion in the second quarter alone, on nearly a fifth of sales, and any guidance on the trend here. Also, any comments on what AI is doing for the business now, and what returns on investment Amazon.com can generate on that spending going forward. There'll be plenty of activity in the coming week on the home front as well, where a trio of banks may take centre stage, as Barclays, Lloyds and NatWest all report third quarter results on the 22nd, 23rd and 24th respectively. Now, Lloyds shares stand at a 10-year high and we will focus here, but the key trends to watch across those three lenders are pretty much the same. Loan and deposit growth, net interest margin, operating costs, loan impairment losses, and in Lloyd's case at least, any fresh conduct costs, where the bank has already acknowledged it will be taking another £800 million in compensation costs relating to the car financing and commissions investigation launched by the Financial Conduct Authority. That will take the total paid out to some £2 billion. We will find out whether this extra 800 million will be taken in the third or the fourth quarter, but the base for comparison last year is provided by the headline pre-tax profit figure of £1.8 billion recorded in the July to September quarter a year ago. It'll also be interesting to see if the additional car financing compensation costs in any way affects Lloyd's plans to return cash to its shareholders. Lloyd's has thus far announced £1.7 billion in share buybacks for 2025, or that's the plan, and analysts expect £2.7 billion for 2026. Chief Executive Charlie Nunn's unlikely to discuss dividends, though, until the full year results, and they're due in early 2026. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.